Rob, how do you actually protect client portfolios when markets fall?
So we're investing on a multi-strategy approach to do this. So if we look at the four areas which we think will protect on the way down, we quite strongly think that stage two is deflationary. So if we go back to the slideshow there and we look at stage two, the deflationary environment, if it's deflationary and they're lower interest rates, then government bonds can go up in value. If someone has a 5% government bond and someone else has a 1% government bond, the 5% government bond goes up in value till it gets to 1%. So you make money on longer term government bonds.
Okay.
So government bonds is number one. The Aussie dollar potentially going down quite significantly. If we have overseas assets, we can make money on a falling currency, or protect from our overseas assets. So we might have some of those overseas assets, share market going down, but the Aussie dollar could go down equal or a greater amount potentially. So there's that. We think the gold price will go up, but we think the gold miners will do better than the gold price, because the gold miners get a triple tailwind. They get the rising gold price, the falling currency, which means in Aussie dollars, the gold price doesn't just go up in US dollars, it goes up again in Aussie dollars.
Yep.
And we also get the lower wage pressure, which is currently a problem for the gold companies. So they actually have potentially lower wage costs. They get triple tailwinds, so margin expansion from three different areas. And the fourth one is, so we have a couple of other positions which have a similar thing to gold, which are they get margin expansion from having overseas revenues, so US dollar predominantly revenues, and Australian dollar costs. So if the Australian dollar corrects, it's part of the Australian dollar thesis, but the companies should go up significant margin expansion, and a lot more than just the Aussie dollar going down. If the Aussie dollar goes down 50%, you can make 50% on a lot of these companies. If you can increase your profits by 2 or 3 times, you actually make a lot more money from the margin expansion from the falling dollar.
Yep. And what drives your investment decisions? What do you deliberately avoid?
So we're certainly looking at things which, because we think that if we do get to Dario Modi's forecast of 10 to 20% unemployment, then the demand destruction, and someone's job is someone else's spending. So someone's job is someone's spending, which is someone else's job. Sorry. So if someone has a job and they stop spending at David Jones, then David Jones starts to reduce employment. So someone's spending is someone else's job.
Yep.
So demand destruction could be quite significant. So we're trying to avoid almost everything with consumer-based dependency. Financial-based dependency is often a lot of the problem, because there's quite a bit of leverage in the global economy. We've got some of the highest global debts in history, going into potentially one of the largest deflation events in history. So those two are not correlated, but the financial system is not designed for deflation. So the financial system with significant debts, if you have, and there's quite a few of these larger super funds have 50 to 80% leverage in some of their office property. If they have 80% leverage, that means you only need to lose 20% on the value of the office before you run out of 100% of your equity. That then becomes a solvency issue if they can't pay their debts. So we have financial areas where we're trying to avoid, and just generally speaking, we're also trying to avoid marginal companies and companies that don't have pricing power and companies who have any debt.
Interesting. And how do you know when a portfolio needs to change, and what tells you it's time to act? What tells you one of these cycles has hit?
Good question. I think a lot of people will wait until the job numbers come out and say, okay, we're now at 10% unemployment. That's too late. I think the markets are forward-looking. So if you look at the stock market, I think there's somewhere between a 12 to 18 month forward-looking scope on the stock market. So if they see job losses trickling up, but then they see it likely to accelerate because they understand that AI is going to not stop, AI is not going to stop getting better, then the market will react before the job losses actually get to Dario's actual 10 to 20% unemployment. It might take 5 years to get Dario's 10 to 20% unemployment, but the stock market might have dropped well before that actually happens. So yes, it might take 5 years, but the stock market might bottom after 2.5 years. So we think that waiting for the data to come out might be too late. That's why we have our own bespoke in-house job tracker to look at leading indicators, not forward indicators. We're keeping that data fairly quiet to ourselves. We don't want that's our own IP, and we don't want everyone else to copy exactly what we're doing. So we should be able to see it, because we're looking at this from 6 different angles. So we should be able to see this in one of the different areas we're looking at, sort of potentially 6 weeks to maybe 3 months before everyone else does.
And that will give you time to react and adjust.
Well, I mean, we've already reacted and adjusted the portfolio. So we think that the probability of this coming over the next 2 to 5 years is very high. So there's no point in sitting around, because if we sit around thinking this starts in 12 months' time, but in that same period, oil prices go up to $180 a barrel because the Strait of Hormuz is blocked, then the stock markets go down before you get a chance to get out. So the reason we got out before we think it actually starts, we think this starts probably in 6 to 12 months. Not now. The job losses haven't actually started in earnest yet. Yes, there's been a couple of announcements, but we're talking about the big start. The start of this is probably later this year, but to the beginning of next year.
In the near future, basically.
Yeah, correct.
And I mean, if your strategy is not working as expected, what does accountability look like? What do you do to adjust it?
Yeah, so if we're wrong and we see that this is not going to cause, and it's causing the productivity boom, which is probably the scenario where we're wrong, because the scenarios we're wrong is if we're slightly wrong, it still increases unemployment somewhat. And that still causes a mild recession, and that still causes the stock market to go down. We're still somewhat correct. Where we could be,
you win tells you win.
Yeah, well, yeah. So the scenario where we could be wrong is this does cause a productivity boom and very slight job losses, but all of a sudden we start to see everyone starting to create new jobs. And that's very difficult to see if that's going to happen. We do think that that's not likely, because we think the new jobs will be a jobless boom. So if you're starting up an AI greenfield company today, you don't go out and employ 100 people, you get 10 people and you use AI for the other 90. So these new companies are far more efficient in terms of the number of people they're employing, and they're just not employing lots of people. They're using AI instead, AI agents instead of people. Okay. So we don't think that's likely, but if we do see AI causing a boom, we're happy to reinvest back into markets if we realise that's the scenario. But we need to see strong evidence that there's a hiring boom and actually potentially job shortages, because it's creating more jobs than it's losing.
Very interesting. Final one, bit of a fun one. So if I ask AI the same questions, is it going to give me the same response?
No. So the secret to using AI is you need to get it to ask you potentially 100 questions to get it to understand the context of what you're trying to get to, because AI tries to answer questions quickly and use as few tokens as possible. The reason why a lot of people are getting bad answers and getting a lot of misinformation out of AI is because they're not using it correctly. You need to make sure the AI is using only official data sources. You need to make sure it doesn't read some opinion by someone who's just written on Reddit. It's actually using a lot of Reddit, actually, which is that's where it trained a lot of these things. So you can't let a Reddit thread pollute your thinking. So you need to make sure that you're training the AI how to think, what to think, and then get it to ask you the questions, but usually 100 questions before you can answer one question. Okay. So you can't just go and ask these questions to AI. You need to say, well, this is the context. I want to know what's going to happen to stock markets, and you need to work through multiple scenario analysis for it to understand. Otherwise, it'll just use whatever forecasts are out there by everyone else. But if the forecasts out there by everyone else are using the wrong inputs, then you're getting the wrong outputs as well.
Very interesting. I'll use a Facebook post, for instance.
Yes, exactly.
Rob, again, thanks for joining us.
Thanks very much.
Little snip. And this is James Meehan, Rob Shears signing off.
Thank you very much.